How do I know if my investment portfolio is performing well? Imagine checking your investment portfolio and feeling confident about its progress. But how can you really tell if it's doing a good job? Let's walk through some simple ways to evaluate its performance. First, look at the total return. This tells you how much your investments have grown or shrunk over a certain period, including price changes, dividends, and interest earned. If your total return is positive and meets your expectations, that's a good sign. Next, consider the annualized return. This averages your yearly gains or losses over time, giving a clearer picture of consistent growth rather than short-term spikes. For example, if your portfolio grew 20% over 2 years, the annualized return is about 10% per year. Now, think about volatility. This measures how much your portfolio's value fluctuates. Big swings mean higher risk. If your investments are very volatile, they might not match your comfort level. Understanding this helps you decide if your risk is appropriate for your goals. Another key measure is the risk-adjusted return, often called the Sharpe ratio. It compares your portfolio's return to a risk-free investment like government bonds, considering how much risk you took. A higher Sharpe ratio indicates you're earning good returns for the risk you're taking. Then, look at alpha and beta. Alpha shows if your portfolio is outperforming or underperforming a benchmark after adjusting for risk. Beta indicates how sensitive your portfolio is to market movements. A beta above 1 means your portfolio is more volatile than the market. Below 1 means less volatile. Comparing your returns to relevant benchmarks, such as the S&P 500 if you mainly invest in large U.S. stocks, helps you see if your portfolio is doing better or worse than the overall market. If your portfolio consistently beats the benchmark after fees and risk adjustments, it's performing well. Also, check if your investments align with your goals. Are you on track to meet your retirement, education, or other financial objectives? Your portfolio should support these goals within your planned timeframe. Asset allocation and diversification are important too. A balanced mix of stocks, bonds, and cash suited to your risk tolerance helps manage risk and income. Rebalancing periodically keeps your portfolio aligned with your target allocation. Costs and taxes matter as well. High fees or poor tax planning can eat into your returns. Make sure your expenses are reasonable and consider tax-efficient strategies. For many adult investors, generating steady income from dividends, interest, or bond coupons is also a sign of good performance. Finally, review your portfolio at least once a year or when your financial situation changes. If it underperforms or doesn't meet your goals, investigate why. It could be market conditions, high costs, or mismatched risk levels. Adjust your strategy accordingly. In the end, a well-performing portfolio is one that delivers returns that match or beat relevant benchmarks, fits your risk comfort, supports your goals, stays diversified, and manages costs well. Regularly checking these factors will help you see how your investments are doing and guide you to make smarter decisions for the future.